Welcome to the Introduction to Financial Accounting Reports. There are 4 financial accounting reports that we will study. The income statement, where revenues minus expenses equals net income. The statement of retained earnings, where beginning retained earnings balance plus net income minus dividends equals the ending retained earnings balance. The balance sheet, where assets equals liabilities plus equity, and the statement of cash flows, where cash inflows minus cash outflows equals net change in cash, and then net change in cash plus the beginning cash balance equals the ending cash balance. This gives a summary of the financial statements we'll be studying and the information that's contained in each of the financial statements. But before we get started, we need to get a better understanding of the assumptions, the principles, and the conventions underlying the preparation of these financial statements. While studying these assumptions, principles, and conventions is not terribly exciting, it is necessary to gain a greater understanding of the financial reports once we get to them. So we'll start with the assumptions. The first assumption underlying financial reporting is separate economic entity. Economic events are associated with a business entity and are separate from the owners of the business entity. The second assumption is going concern. The going concern assumption assumes that businesses will continue in the foreseeable future. This assumption is necessary because it allows us to not worry about liquidation values when we're preparing our financial statements. The next assumption is the stable monetary unit. Financial reports are prepared using a stable monetary unit, for example, the US dollar. In periods of extremely high inflation or extremely high deflation, the financial statements are less relevant because the monetary unit changes so drastically during those time periods. The last assumption is periodicity. Accounting reports are prepared periodically. For example, accounting reports are often prepared monthly, quarterly, or annually. The periodicity assumption allows us to break the business's life cycle into these time periods and prepare financial reports associated with the time period indicated, either monthly, quarterly, or annually. Next, we'll discuss the principles underlying financial reporting. The first principle is the historical cost principle. Assets, which we'll later look at in more detail, are reported and presented at the original cost, and no adjustment is made for changes in market value. While financial statements have historically been prepared based on historical cost, that's not true for all assets. It is true for most assets, and as we study the different types of assets, we'll identify when historical cost is used and when we use other measures for reporting assets. The matching principle indicates that expenses and revenues will be reported in this period incurred and earned. We're going to study expenses and revenues in more detail later, but matching says we'll report expenses and revenues in the period in which the expenses were incurred and the period in which the revenues were earned. The revenue recognition principle, also referred to as the realization principle, indicates that revenue is realized when the good or service is provided. Now, realized means reported on the income statement. The final principle is the full disclosure principle. The full disclosure principle requires that all information about the business entity that is needed by the users is disclosed in understandable form. That's not to say that every possible thing is disclosed, but everything that's needed by a reasonably informed and educated user is provided in the financial statements. The conventions that we use include materiality convention. Materiality relaxes certain GAAP requirements. Remember, GAAP is the rules that we follow if the impact is not large enough to influence decisions. And the question that you ask yourself in determining if something is material is, does it matter? Would reporting a particular item in a certain way change the decision made by a user? If the answer to the does it matter question is no, the decision wouldn't change, then the reporting is immaterial. The cost-benefit convention also relaxes GAAP requirements if the expected cost of reporting something exceeds the benefits of reporting it. Remember, we are still obligated by regulatory and legal requirements, but the cost-benefit convention does allow for the relaxing of certain GAAP requirements. Finally, industry practices convention. Industry practices should be followed even if they differ from GAAP. Oil and gas is a particular industry where there are some very unique accounting standards. So let's review. The financial statements that we will study are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. The assumptions underlying financial statements are separate economic entity, going concern, stable monetary unit, and periodicity. The principles underlying financial statements are historical cost, matching, and revenue recognition, and finally full disclosure. The modifying conventions are materiality, cost benefit, and industry practices. Okay, let's practice. Our first question. The assumption that a business will continue indefinitely is separate economic entity, going concern, stable monetary unit, or periodicity. The periodicity indicates that we will divide the life cycle of the business into time periods. Common time periods are months, quarters, or years, and we can prepare financial statements associated with each of those periods. The stable monetary unit assumption is that the monetary unit used in the financial statement is very stable. There are not periods of extremely high inflation or extremely high deflation. Going concern indicates that the business will continue into the foreseeable future, which is very consistent with our question. Separate economic entity indicates that the business is separate and distinct from its owners. The affairs of the owners are reported separate from the affairs of the business. So the question, the assumption that a business will continue indefinitely, is best answered by B, going concern. Our next question. Ray Dunn, owner of Dunn-Wright Pest Control, purchased a new car for his wife's personal use and recorded the car in the accounting records of the business. What assumption is violated? Separate economic entity, going concern, stable monetary unit, or periodicity. We just defined each of these assumptions in the previous question, and we know that separate economic entity indicates that the affairs of the owner should be separate from the affairs of the business. So by reporting the personal vehicle in the business records, we're violating the separate economic entity assumption. Our next question. Ray Dunn, owner of Dunn-Wright Pest Control, purchased a new car for his business. The list price was $27,000, but he only paid $23,000 for the car. What principle helps to determine the correct amount to record in the accounting records for the purchase? Historical cost, matching, revenue recognition, or full disclosure? Full disclosure requires that we report all information that's necessary to interpret the numbers contained in the financial statements. Revenue recognition requires us to report revenue on the income statement when it is earned. Matching requires us to report expenses and revenues when incurred and earned. And historical cost says that we report assets at their cost. So this historical cost principle would tell us to report the asset at cost, and the cost is $23,000. So the best answer is A, and the historical cost would be $23,000. Our next question. Ray Dunn, owner of Dunn Wright Pest Control, signed a contract with a client to provide 1 year of pest control service. What principle helps to determine when to recognize the revenue for providing the service? Now remember, recognize means to report in the income statement. So historical cost, matching, revenue recognition, and full disclosure. We just discussed each of these, and we know that revenue recognition deals with when to report revenue in the income statement. Revenue is reported in the income statement when it is earned or when the good or service is provided. So wrapping things up, why is financial reporting cool? Accountants prepare reports that support economic decisions. That means accountants still rule the world.